The Sloth Investor's Bite-Sized Summary of Millionaire Teacher by Andrew Hallam. Millionaire Teacher. There's certainly two words you don't usually hear together in the same sentence. In this video, you'll learn how Andrew Hallam, a former international school teacher, became a millionaire. Well, are you ready for another unusual word combination? Let's try a millionaire mechanic. Summary point 1. The Millionaire Mechanic. Millionaire Teacher is probably my single favorite investing book. Indeed, the Sloth investor's life was transformed when he read Millionaire Teacher for the first time. Likewise, Andrew Hallam, the author of Millionaire Teacher, had his life transformed when he met a millionaire mechanic. When Hallam was 20 years old, he took a summer job washing buses at a bus depot to pay for his college tuition. However, what he learned from this insightful mechanic was more valuable than anything he learned at college. The mechanic, a gentleman by the name of Russ Perry, was a millionaire mechanic raising 2 kids as a single dad. His financial acumen was revered by the other mechanics. While talking to Hallam, the other mechanic stated, "Hey, if Russ ever wants to talk to you about money, make sure you listen." So wisely, Andrew did just that. Russ informed Andrew that he could tell how smart someone was by simply looking at what they drove. The mechanic couldn't figure out why anyone would pay a lot of money for something, such as a luxury car, that depreciated in value over time. Russ recommended investing in assets such as houses or stocks that appreciate over time, but cars lose money every year. Russ, the millionaire mechanic, stated to Andrew, "If you can go through life without losing money on cars, you're going to have a huge advantage. If you're truly wealthy, then there's nothing wrong with blowing money you can afford to lose on the odd luxury item. But if you're trying to become wealthy and you make those kinds of purchases, you'll never get there." Summary point 2. Spend like you want to grow rich. The lessons that Andrew Hallam learned from Russ, the millionaire mechanic, lead us nicely into the importance of spending like you want to grow rich. According to Hallam, if you're interested in building wealth, you should make a pledge to yourself much like a doctor's Hippocratic oath, which is, above all, do no harm. We're living in an era of instant gratification. It's easy to harm our future by blowing money we don't have. To stay out of harm's way financially, we need to build assets, not debts. As Hallam states in the book, one of the surest ways to build wealth over a lifetime is to spend far less than you make and intelligently invest the difference. Unfortunately, according to Hallam, too many people hurt their financial health by failing to differentiate between their wants and their needs. As a result, this leads many down a road of hyperconsumption, which can ultimately lead to debt. In Chapter 1 of Millionaire Teacher, Hallam uses an example from Greek mythology to make a key point about debt. Zeus punished Sisyphus by forcing him to continually roll a boulder up a mountain. It then rolled back down every time it neared the summit. Many consumers face the same relentless treadmill with their consumption habits. When they get close to paying off their debts, they reward themselves by adding weight to their own boulder of debt. It knocks them back to the base of their own daunting mountain. Quite simply, according to Hallam, before we learn to invest to build wealth, we have to learn how to save. If we want to grow rich on a middle-class salary, we can't be average. We have to sidestep the consumption habits to which so many others have fallen victim. By minimizing the purchases that you don't really need, you can maximize your money for investment purposes. Let's round off summary point 2 by exploring a little further what Andrew Hallam has to say about debt. He talks about his early aversion to debt. Hallam states in the book, "I hate debt. It's going to sound extreme, but for me, owing money is like making a deal with the devil. Always thinking of the worst-case scenario, I would worry what would happen if I lost my job and couldn't meet my debt obligation payments. Thinking of debt as a life-threatening, contagious disease served me pretty well." Summary point 3. The Evolved Investor and the Average Investor. Okay, so we've explored how a millionaire mechanic influenced Andrew Hallam's approach to spending money, but how did Andrew Hallam invest to become a millionaire? Well, just like the Sloth investor, Hallam is a fan and a buyer of low-fee, globally diversified index funds. So, what is an index fund? A low-fee, globally diversified index fund contains thousands of stocks from around the world across a broad range of different industries. From a young age and throughout his teaching career, Andrew Hallam has invested his money in such funds. Let's reflect now on why Andrew Hallam and a Sloth investor are such fans of index funds. A key reason is that they enable you to take the guesswork out of investing. For instance, how can we be sure which stock, which sector, or which country will outperform? None of us possess a crystal ball. As the late Jack Bogle, the individual credited with creating the first index fund, stated, "Don't look for the needle in the haystack, just buy the haystack." So what represents the haystack in the investing sense? Quite simply, it's a broadly diversified index fund containing a varied collection of stocks from around the globe. Unfortunately, too many investors have failed to recognize the utility of simplifying their approach to investing by investing in low-fee index funds. A significant number of investors continue to invest their money in actively managed funds. Such funds are typically high-fee and are run by a small group of investment professionals that are handsomely financially rewarded for selecting their own assortment of companies and sectors to invest in. The problem is that the vast majority of active funds are inferior to index funds. Index funds, because they're far more diversified, tend to produce slightly higher returns at lower risk than actively managed funds, which, by definition, are more heavily concentrated. In Millionaire Teacher, Andrew Hallam makes a comparison between two types of investors: the evolved investor and the average investor. The evolved investor buys index funds, dollar-cost averages into index funds, and recognizes that this buys fewer shares as the stock market rises. Loves to see the stock index fall in value. In such a scenario, if he or she has the money, the person increases purchases. In contrast, this is how the average investor invests. The average investor buys actively managed funds, feels good about his or her fund when the price increases, so buys more of it. Feels bad about his or her fund when the price decreases, so this person limits purchases or perhaps even sells the fund. Before we move on to the fourth summary point, let's finish with a quote from Andrew Hallam on the evolved investor. I'm not going to suggest that all indexed investors are evolved enough to ignore the market's fearful roller coaster while shunning the self-sabotaging caused by fear and greed. But if you can learn to invest regularly in indexes and remain calm when the markets fly upward or downward, you'll grow far wealthier. Summary point 4. Small fees pack big punches. In addition to their broad diversification, there's another key reason why Andrew Hallam is such a fan of index funds: their low fees. If we take most industries, it's easy to understand why the professionals within that industry command a high fee. For example, if I need a tooth to be extracted, I'm willing to pay a justifiable fee that will account for the high level of expertise that a dentist possesses. However, the realm of investing is uniquely different in that the high fees paid by individual investors may not necessarily result in the desired outcome, a high return on one's initial investment. In Millionaire Teacher, Hallam explores this further. Hallam writes about how most investment professionals don't want you to buy index funds because they make far more money in commissions and fees when they convince you to buy actively managed funds. So, what explains the high fees of actively managed funds? Let's explore two key factors. Expense ratios. Expense ratios are the costs associated with running an actively managed fund. If you buy an actively managed fund, hidden fees pay the salaries of the analysts that select which stocks to buy and sell. These investment professionals are expensive to employ, and they are handsomely rewarded. Moreover, expense ratio fees also incorporate costs such as office leases, computers, and electricity. Finally, the owners of the fund company will also naturally skim some money from the expense ratio into their own back pocket. Trading costs. The term trading cost refers to the buying and selling of stocks within an actively managed fund. It's important to remember that actively managed funds are run by financial professionals who buy and sell stocks to try and gain an edge. This continual process of buying and selling stocks on the part of active fund managers isn't cheap, though. It's yet another cost that will be passed on to you should you decide to invest in actively managed funds. Summary point 5. Time, the greatest investment ally you have. Remember how I stated at the start of this video how Millionaire Teacher is a key text that shaped the Sloth investor's investment philosophy? Well, one chief reason that led to me including time as one of my 5 bedrock principles is Andrew's journey as an investor. From a young age, Andrew Hallam made the wise choice to invest his money in low-fee, globally diversified index funds. As a result, by the age of 36, he became a millionaire. 4 years later, at the age of 40, his portfolio had grown even more, granting him financial independence. Chapter 2 of Millionaire Teacher focuses on the importance of time, and this is what Andrew Hallam considers to be our greatest investment ally. As he rightly states in that chapter, stock markets can fluctuate dramatically. They can even move sideways for many years. But over the past century, the U.S. stock market has generated returns exceeding 9% annually. As Hallam notes in the book, this includes the crashes of 1929, 1973 to 1974, 1987, 2008 to 2009. Committing to a long-time horizon is critical to your success as an investor. Despite the inevitable bouts of volatility that are a natural feature of the stock market, it's crucial that you stay the course, remaining invested for your lifetime. Indeed, remaining invested through the bad times and committing to a long-time horizon is what enabled Andrew Hallam to retire at the age of 40. So that's Mr. Sloth's summary of The Millionaire Teacher by Andrew Hallam. To listen directly from the author of the book, you can watch my interview with Andrew Hallam by viewing episode 28 of the Sloth Investor podcast. You can find a link to that interview in the description to this video. Also, you can find a link to my summary video of Balance, another fantastic book by Andrew Hallam, in the description to this video. To keep up to date with the latest content from the Sloth Investor, whether this be my podcast or other video content, please remember to subscribe to this channel.